Welcome to the Riskwiser Zone, where we navigate the twists and turns of the financial world to help you make informed decisions about your investments. We're going to kick off our show with a story that's got everyone in the investment community buzzing: the upcoming SpaceX IPO. With a valuation expected to be around $2 trillion, it's no wonder that retail investors are eager to get in on the action. But as we all know, getting in early on a hot IPO can be tough, especially when demand is high. That's why some investors are looking for alternative ways to get exposure to SpaceX before the company goes public. One such way is through EchoStar, a company that has agreed to sell wireless spectrum to SpaceX for its Starlink project. The deal could be worth up to $20 billion, including up to $11 billion in SpaceX stock. Now, we know what you're thinking. Is buying EchoStar stock a good way to get in on the SpaceX action? Well, it's not a straightforward answer. On the one hand, EchoStar's legacy satellite TV business is under pressure, with declining subscribers and revenue. But on the other hand, the company's spectrum sale to SpaceX could bring in a significant windfall, and its stake in SpaceX stock could be worth tens of billions of dollars. As always, we want to caution our listeners to approach this investment opportunity with a critical eye. While EchoStar may offer a backdoor way into SpaceX, it's not without risks. The company's core business is struggling, and there are execution risks associated with its spectrum sale and debt repayment plans. So, what's an investor to do? As we always say on the Riskwiser Zone, it's essential to do your own research and consider multiple perspectives before making any investment decision. We'll be keeping a close eye on the SpaceX IPO and its impact on the market, and we'll bring you updates and analysis as more information becomes available. In the meantime, remember that investing in the stock market always involves risks, and it's crucial to manage those risks wisely. Don't get caught up in the hype or FOMO. Take a step back, assess your financial goals and risk tolerance, and make informed decisions that align with your overall investment strategy. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a complex and volatile situation unfolding in the Middle East, where tensions between the US and Iran continue to escalate. The Strait of Hormuz, a critical waterway for global oil trade, remains largely closed, with significant implications for the global economy. Piper Sandler's recent note suggests that the disruption across the strait is likely to persist for months, pushing oil prices to new highs this summer. This warning comes on the heels of the U.S. conducting self-defense strikes in southern Iran, targeting Iranian missile launch sites and vessels placing mines around the strait. The investment bank expresses little confidence that commercial traffic through the strait will return to even 50% of its pre-crisis levels anytime soon. The U.S. appears unwilling to press the fight due to concerns about the scale of Iran's retaliation, which could have broader implications for neighboring countries and global supply chains. Meanwhile, Iran's leaders seem unwilling to settle for any compromise, believing they have leverage in the situation. This stalemate reinforces concerns that the strait closure could extend for months, with far-reaching consequences for economies reliant on shipment through this vital waterway. As we navigate this complex landscape, it's essential to consider multiple perspectives and potential outcomes. The situation remains highly fluid, with ongoing negotiations and developments that could impact the trajectory of events. With oil prices already experiencing significant fluctuations, the potential for further disruption and price increases is a pressing concern for businesses and consumers alike. As we continue to monitor this situation, it's crucial to prioritize fairness, balance, and accuracy in our analysis. Welcome back to the Riskwiser Zone. Today, we've been discussing various topics that impact our financial lives, from market trends to economic shifts. As we close out this episode, let's take a look at some interesting news coming out of China. industrial profits in the country have seen a significant surge, with a 24.7% increase in April compared to the same period last year. This is the fastest growth in over 2 years, driven largely by demand for artificial intelligence-related goods and the recent spike in oil prices due to geopolitical tensions. This uptick in industrial profits could have broader implications for the global economy, especially considering China's role as a major manufacturer and exporter. However, it's also important to note that not all sectors are benefiting equally from this growth. While companies involved in upstream production, such as oil and gas, are seeing significant gains, downstream factories, particularly those in consumer goods like apparel and furniture, continue to face challenges due to soft household spending and intense price competition. The divergence in profit growth among different industries highlights the complexities of China's economic landscape. As we consider these developments, it's crucial to maintain a nuanced perspective, recognizing both the opportunities and the challenges that arise from such shifts. Whether you're an investor looking to capitalize on growing trends or a consumer interested in understanding the broader economic context, staying informed is key. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.